The best way to treat any point of interest is to look at the market not just in terms of structure alone, but also in terms of liquidity. So in this price action example, we had an impulse, a retracement, and another impulse indicating the willingness of price to continue even lower. Now, more often times than not, a lot of traders looking for a return into this order block and a continuation to the downside. But let's be honest, if everyone is selling this point of interest, who is buying? Because for our sell orders to be filled, we need a bunch of buyers to be on the opposite side of our position. So the question now is, what makes the most logical sense? Now, more often times than not, when we have such an impulsive move to the downside, we're left with imbalances and a bunch of improper price action. And when price usually comes back into the area, because there isn't any sort of structural liquidity here, it ends up manipulating the high of the point of interest. In our second price action example, we can see that we have a slightly different price action compared to the first. Now, before price made an impulsive move down, breaking the structure to the left, we can see a slight pause sideways. Now, I love this kind of points of interest because I considered it to be a pocket of liquidity sitting below a bearish order block. And more often times than not, when price comes back into these points of interest, we usually have a sweep of liquidity above these equal highs here. And more often times than not as well, we're left with some slight imbalances and a very, very reasonable order block to trade from. And when price comes back into this area, we're not just sweeping the liquidity here, but we're also mitigating any unmitigated order block and then leading us to a continuation to the downside. Now, I've made a ton of videos like this on YouTube, and if you comment the word guide, I'll send you a link.